Thank you, Eric. So now Eric has established that I'm an economist. That means two things. I love pretty charts, and they're most often wrong. So I'm going to spend a couple of minutes talking about the private markets from the Lloyd's perspective, looking a bit about how the market has grown and developed over the last 15 years or so since 9/11, then really getting in a little bit more into the nitty-gritty, looking at some of the coverage and the gaps and what the structures of the markets really need for this before handing over to Michael. So I'll get straight into it because, like many of the other speakers, I do like the sound of my own voice, which, given what it sounds like in the microphone, seems to be a bit of a mystery, I guess. But here we go. The first chart here, it shows the growth in premiums and the growth in number of participants in the Lloyd's market. Anecdotally, we think that this is the largest private terrorism insurance market in the world. So if nothing else, we can perhaps use it as an indication of how the market has developed over the last decade or 15 years and so. So going back to the period after 9/11, a lot of different markets withdrew from terrorism insurance. And in the Lloyd's market, they could just about scrape out about 100 million or so worth of capacity in pounds terms. And there were about 30 or so different participants. However, since then, I think I went to another presentation and called this I called terrorism a Lloyd's success story, but that was not really the message I was looking to convey. So I've kind of toned it down a little. But since then, we have virtually seen a tenfold growth in premium. So at the end of 2015, there was about 1 billion worth of premium in GBP terms written in the market. I guess at today's exchange rate, that's probably 1.1 billion euros, perhaps a little bit more. But of course, pre-Brexit, that would probably have been quite a bit more back then. And at the same time, we have seen the number of syndicates participating in the market growing from about 30 or so post 9/11 up to almost 90 today. We can also look at the growth in the market in terms of exposure or limits. And if we use 2006 as a base year, because my lawyers aren't necessarily allowing me to bring something that's too precise here, but if we use 2006 as a base year of 1, then we did see between 2006 and 2011 a growth in the number of participating syndicates of about 50%, as you saw on the last chart, and similarly the change in capacity or limit was about 50% as well. However, between 2006 and 2015, we have seen that the change in capacity has about grown 3.5 times from the base year. And what I can tell you, that broadly means that for a good risk on a good day, you can typically get in the billions of pounds worth of coverage offered to you in this one place, in this one market. And similarly, as I pointed out, between 2006 and 2015, the number of participants in the market has almost doubled. So there is a willingness to grow and to bridge the gap. Of course, looking at the chart that we just saw, there is obviously a very large gap still there to fill. So despite the, I guess, significant growth we've seen in the market, we're not all the way there. I think this is quite interesting as well, especially in light of some of the presentations we heard before. US and Canada, in terms of risk location, tends to be the most mature market, and about 1/3 of the insurance policies or 1/3 of the premiums comes out from there. This is being closely followed by the UK and Asia Pacific, having about 50 each. Then afterwards, we have Europe with slightly lower premiums. And finally, if you look at Latin America and rest of the world, that's a much lower proportion. I think the interesting bit, drawing from what Jamie was talking about earlier, is that rest of the world, that's probably the region where we see the largest number of terrorist attacks. But at the same time, that's where the coverage is the very lowest. And anecdotally speaking with some of the participants in the market, places such as Egypt and Oman, you can get insurance there, but insurers are not necessarily that interested in growing in these regions because it has perhaps not been that profitable. At the end of the day, most of the people in the private markets are there to make money, of course. Oh, I see one of the things have dropped off here, the bottom. This is the split in a method of distribution, and the kind of bread and butter business, the open direct insurance, which is the bottom gray. That's typically about 40% of the business written in the market. Secondly, you have reinsurance, and it's worth pointing out here that Lloyd's or private markets in general provide some capacity to the public reinsurance pools, of course. That's about a third of the market. And finally, for binder and line slip, including facilities, you have about 30% or so of the business is written through this method of distribution. However, since 2010, we have seen about a doubling in the amount of business being written through binder and line slip. And there are obviously two sides to this coin. The one side is by using binders or MJs or whatever, you might have the opportunity to get more local coverage and have delegated authorities that can actually access business and provide coverage in areas where perhaps private markets didn't traditionally penetrate that well. On the other hand, this trend also means that the insurers in the big markets, they are to an increasing extent giving away their pens, and there might be less of a understanding or exact understanding of the types of coverages being written. And I think from my perspective, as we're some sort of, I guess, mutualized arrangement with the Lloyd Central Fund on top, understanding what's in the book of business and what's effectively covered, I think it remains very important for everyone in insurance in general. So now that I've bored you a bit with my pretty colors, no, I am a bit colorblind, but it's actually the Lloyd's colors, so you can't blame me for those. Then I think it's worth talking a few seconds about the trends in the market, and then a short discussion on, I guess, the coverage and gaps, or what this is telling me. So the market, which we think is a complement to the public pools, can syndicate significant risk. So for the right risk on the right day, in the billions of pounds or dollars worth of limit, as I said, but they can also provide very bespoke cover to suit clients' needs, and we do see some of this. At the same time, falling rates, as you know, across the industry as a whole, has been putting pressure on traditional terrorism underwriting. So what has been, I guess, rapidly growing business, as was said earlier, there may have been falls in rates between 5 to 7% per year for a number of years. That actually means as rates are falling, there are less appetite in the market to bridge the gap, to go out and look for new business. But at the same time, the market has remained very resilient, because as you all know, traditional terrorism products, they have not necessarily seen any 9/11 type events with really large losses since 2001. And finally, of course, the changes in the distribution channels, it can also serve to impact the market dynamics, the advantage with more localized experts penetrating new markets, but also the risks that it may bring. Finally, and I don't know how I'm doing on time, still okay, perfect, yeah. So in the market, you can also find things such as MBCR coverage, but it will typically be excluded from traditional terrorism policies, as you know. There are also some very heavy sublimits when it is bought, or much less capacity in the market. So if you're looking in the billions of dollars for the normal kind of vanilla or traditional terrorism policies, then for NBCR, you're kind of, if you're a very motivated buyer, you can be looking at coverage in the hundreds of millions at most. At the same time, I think the demand bit is an interesting factor here, and client behavior very much dictates what is being sold. So anecdotally in the market, I think clients, when they are interested in these type of coverages, it's much more around chemical and biological and less of an interest in nuclear and radiological. I think one reason of this may be because people in general struggle very hard to actually understand and correctly value events with a very low probability of occurrence. Cyber, and I know some of the colleagues here around the panel will talk about this, so while I would love to kind of, I guess, front them and steal all of their thunder, I'm not going to go too far into it. But it's generally excluded and still pretty rare. But you do see that there is a willing to experiment in the market with these types of coverages, and there have been a number of them sold. And also, of course, they're written back through certain perils in certain regions. For example, the famous NMA 2915 in the US, for example. We see, as been established here already, an increased focus on business interruption and contingent business interruption, but also things such as a threat, loss of attraction, malicious attack with a much wider range of weapons and triggers for all of this being, I guess, experimented with in the market. And there are a number of different products. I know Michael, for example, will talk a fair bit about that, I believe. So at the end of the day, the market is focusing on innovation to remain relevant, to effectively meet this new threat and how it has morphed. But there are still a number of challenges with penetration, and hopefully I've highlighted some of these in the last 12 minutes. Thank you.
Yeah, thank you, Albert.